Hey, good morning, everybody. This is Bob Trade Genius, the 7th of September. What I want to show you here is a, a possibility, and we call this the Eiffel Tower effect. We had the manipulation from basically the June option contract expiration all the way into basically last week. We had these call buyers basically lifting the price by forcing the market makers into buying the stocks to remain basically hedged. When somebody buys a call, the market makers have to sell a call, and when they sell a call, they basically hedge it by buying the shares of the stock. And so obviously somebody figured out that the calls were too cheap, and they were just driving it higher and forcing the market makers to lift the price. Some call it manipulation, some call it illegal, some call it smart, some call it the calls were underpriced that allowed this to happen. And but be that as it may, it got to the point where it didn't work anymore, and that's right here. And so now we have a couple things that we have to think about. One is, just so everybody knows, because people are talking about the Fed has your back. The Fed has been reducing its balance sheet here over the last couple of weeks. So they're probably taking advantage of this lift in the markets that they don't have to do the heavy lifting, and they've been reducing their balance sheet. So if that maintains over the next 6 weeks, then I think we'll see the market sell off. If they start adding to their balance sheet here going into the election, then we may have a situation where we have, like right here, a weekly bearish engulfing pattern that just basically got absorbed and never made a new low, and then they lifted it again. But if I'm right that the uncertainty with the election and just the heightened awareness of just basically a asymmetric result of the world depending on who wins the election, is that people I think are going to hedge and close positions. And then usually that happens is that these speculations like this bring the market back down to where it was. It also is coming into the weekly 144. So I'm saying my stake in the ground is that by the third week of October, maybe it's like right here, is that we're looking at probably 2,900, 3,000 on the S&P. Which in all things considered is not bad. 10% correction. We definitely need one to curb some of the excess if we want this thing to continue to move higher. But if I'm wrong, is that we'll not make another low here. So what we have to watch for now is, to me, this is the kind of the line in the sand. This has to break before I get uber bearish, and then obviously if this breaks up here, then we're going to go to the freaking moon. So that's kind of what we're dealing with now. We're in this 200-point range, and then who knows, we could just bounce around here like crazy people. So I talked to you about volatility on Saturday. I think if we get closer and closer to October, that backwardation in VIX will start putting some pressure on the market. And that's kind of where I sit. So get really bearish below 33.50, get really bullish above 35.85 area, and in between, just bring your time frame down and bounce it around. So anyway, I thought I'd share that with you guys. You guys have a great rest of the Labor Day, and we'll be hitting it hard again tomorrow. Bye-bye.